Um, Good morning, everyone. So, to put things in perspective, we must know that the firm's primary objective is to maximize shareholder value, and a company can increase this value by investing in projects that earn more than the cost of capital. So, today I will briefly discuss an overview of the weighted average cost of capital. So, this figure 10.1, shows the types of capital firms use. So, debt is typically raised by issuing bonds or borrowing money from a financial institution such as a bank. So, some companies also finance with preferred stock. The third type of capital is called common equity. So, it is provided by the company's common stockholders or shareholders, and it is raised in two ways: new common stock and returned earnings. So the cost of capital for a company refers to the rate of return that investors demand. So it is the average risk investment of a company. It is actually estimated by computing the marginal cost of each of the various sources of capital for a company and then taking a weighted average of these costs. So this is referred to as the weighted average cost of capital. Given that it is the cost that the company incurs to raise additional capital, the WACC may also be referred to as the marginal cost of capital. So the formula for the WACC is this one, the one you see in the screen. So the cost of capital for company refers to the rate of return that investors demand. So there it is. So for example, let's calculate an example problem for weighted average cost of capital. So let's assume that company XYZ has the capital structure, this capital structure, 25% equity, 10% preferred stock, and 65% debt. Its marginal cost of equity is 12%, while its marginal cost of preferred stock is 9%. Lastly, its before tax cost of debt is 7%. If the marginal rate is 35%, what is the weighted average cost of capital of company XYZ? So for this example, we have the following values, and we know that this is the formula for WACC. We just have to substitute each values with this formula. Therefore, the company XYZ's weighted average cost of capital is 6.8%, as you can see on the screen. So let's have an exercise question. So I included one question for this. So in this exercise question, what is the average weighted average cost of capital for a company if it has the following capital structure: 30% equity, 20% preferred stock, and 50% debt? And its marginal cost of equity is 11%. Its marginal cost of preferred stock is 9%, and its before tax cost of debt is 8%. So what is our WACC? Remember to always substitute the values with the formula. So for the solution, the correct answer is B, 7.50%. Just substitute all the given values with our given formula. Easy as it is. You just have to identify which ones are the correct values to use. So without further ado, let's proceed to the cost of debt. So the cost of debt is the total interest expense owed on debt. Put simply, the cost of debt is the effective interest rate or the total amount of interest that a company or individual owes on any liabilities such as bonds and loans. So this expense can refer to either the before tax or after tax cost of debt. So this is the formula as you can see in the screen. After tax cost of debt is equal to interest rate minus tax savings. So it is actually used. We can actually use after tax cost of debt based on the book because It is used to calculate the weighted average cost of capital, and it is the interest rate on debt less the tax savings to the result because interest is deductible. So we should actually use the after tax cost of debt instead of the before tax cost of debt. So for an exercise, suppose Ayala Corp can borrow at an interest rate of 10% and its marginal federal plus tax rate is 40%. Then its after tax cost of debt will be what percent? Here's the solution. After tax cost of debt, we just have to follow the formula. So to review, interest rate minus tax savings. So in our problem, the interest rate would be 10%. The federal plus state tax rate is 40%. So we have to substitute all the values using the formula. So in the end, the after tax cost of debt of Ayala Corp will be 6%. As you can see on our solution, easy as it is. So just note that the cost of debt is the interest rate on new debt, not on the already outstanding debt or your old debt. So to formally close this topic, debt is really unavoidable for most people and businesses. So it can actually help us make major purchases or help finance our growth. So it is it is imperative to understand how it works. Not only are you paying the principal balance, but you're also responsible for the interest. This is referred to as the cost of debt. So to move forward, for my last topic for this particular chapter, it is called the cost of preferred stock. So the component cost of preferred stock used to calculate the weighted average cost of capital is the preferred dividend divided by the current price of the preferred stock. So this is the formula, as you can see. So the rate of return investors require of the firm's preferred stock is calculated as the preferred dividend rather divided by the current price. So you can see the screen. So let's have a short exercise. Of course, we always have a short exercise to illustrate and exercise how this formula works or cost of preferred stock works. So suppose Ayala Corp does not have any preferred stock outstanding and plans to issue some preferred in the future and therefore has included it in its target capital structure. Ayala Corp would sell the stock to a few large management funds. The stock would have a $10 dividend per share and it would be priced at $97.50 a share. Therefore, Ayala's Corp's preferred stock would be. Okay, we always remember that this is the formula of cost of preferred stock. So the solution would be like this. $10 divided by $97.50 is equal to 10.3%. So the cost of preferred stock of Ayala Corp is 10.3%. So as we can see from the equation, 10.3, the cost of debt to equation, calculating the preferred stock cost of stock is generally quite simple, right? So this is particularly true for traditional plain vanilla, quote unquote, preferred that pays a fixed dividend in perpetuity. However, on the previous chapters, we note that some preferred issues have a specified maturity date. Oh, so if you will check it on the book before this chapter 10, there are all chapters like in chapter 9. If you have quite a bit read about it, you can actually see some issues there for maturity date and how to calculate expected return on these issues. So also preferred stock may include an option to convert to common stock and that adds another layer of complexity. to calculating the cost of preferred stock. So that is all. Thank you.